Thank God it's Friday. It's time to do Friday business here on Business Morning. It's 55 minutes that we have to do current and relevant business talks. And we start as usual from what's going on in the global oil space. We see oil resumed its rally after the United States and Iran exchanged fire in the Strait of Hormuz. And that's fanfare that fragile ceasefire between the two countries was unraveling and threatening continued disruption to shipping via one of the world's most crucial oil routes. Washington and Tehran accused each other of initiating attacks in the Strait of Hormuz, further straining a ceasefire agreement that's already weakened by repeated allegations of violations. The flare-up came as Iran is reportedly reviewing a U.S. proposal to end the war. And so we saw below $100 yesterday, but that has changed. It's now $100.62 for Brent after it gained more than 0.5%. WTI is up also $95.13 for a barrel. And we know that President Trump, in a call with some reporters, insisted that the ceasefire remains in effect, saying that strikes were just a love tap. In a true social post, Mr. Trump said that U.S. forces had wiped out the Iranian targets involved in the clash, including small boats and drones. He also has warned that Iran would face further military strikes if it failed to agree to a nuclear deal. And here in Nigeria, the Nigerian Midstream and Downstream Petroleum Regulatory Authority, NMDPRA, they've approved licenses for the importation of 720,000 metric tons of petrol in a move that's aimed at strengthening fuel supply across the country. The regulator says that the approvals are issued to oil marketers and importers to ensure uninterrupted availability of premium motor spirit, especially as demand remains high in major cities and commercial hubs. Industry stakeholders say the import volume is expected to support depot stocks level, improve distribution to filling stations, and reduce the risk of supply disruptions. In the downstream sector, the development comes amid ongoing efforts by the federal government to stabilize the petroleum market while increasing domestic refining capacity through local refineries, including the gradual ramp-up of operations at a newly rehabilitated and privately owned plant. Go to the markets now. Yesterday, we saw almost ₦1 trillion shaved off the local bourse. That's about 1.23%. And the oil share dropped to 239,734.61. For the value, it's 153.858 trillion naira. That's what the market closed at. And looking at the drivers of this, we see volume was green, value was green. However, deal dropped yesterday is in the red. Top gainers yesterday, CAP, FTN Cocoa, and Zikis. So Zikis is back on gaining. We saw it experience some profit taking for a couple of trading sessions, but it's back. For the top losers yesterday, we see UPL, Red Starex, and Sky Urban. But we know that Dangote Cement yesterday was a major market mover at the close of trade experience. A lot of profit taking and ended up or pushed the market into that red zone. And still from the market, we see result, a first quarter result for First Holdco PLC, the parent entity of Nigeria's oldest commercial bank, reestablished itself as a financial powerhouse, emerging as a period of aggressive balance sheet restructuring characterized by massive legacy debt write-offs in the late 2025. So this is how First Holdco performed in the first quarter of this year. We saw a 72% year-on-year profit before tax growth. That's it. And then profit before tax jumped to 321 billion naira from 186.47. Obviously, this is after taking care of those debts in 2025. Post-tax return on equity is at 31.6%. Cost to income ratio improved from 53.8% in late 2025 to 45.2%. Total operating expenses also went up 21% year-on-year to settle at 298 billion, and total assets as at March, end of March, stood at 26.8 trillion naira. So that's the result. Profit jumped 72% to 321. However, we saw that yesterday, yes, for so-called, I think the day before it was down, but yesterday it recovered. I guess the result has also contributed to that. But we did notice that a lot of the Fuga seem to be experiencing more of profit taking in the last 2 or 3 trading sessions. Is it time for correction? Obviously, we've seen the market in a boom for a while. So is it time for correction now? These and other things is what we'll be discussing with Mr. Johnson Chukwu, the Chief Executive Officer of Carry Asset Management Limited. Mr. Chukwu, good morning and welcome to the program.
Good morning, and thank you for having me.
So is it time for a correction in the market? We have been enjoying the gains. We've seen the boom, and we know no market stays on top forever. Should we be preparing ourselves for a correction?
What I would say is that there is a possibility that some stocks will witness corrections in the near future or in the immediate future. I think it's better to say the near future so that I don't say the immediate future, because there's still a lot of excitement in the market. There are stocks that are clearly overvalued, but it's not across all quoted stocks that you can say is overvalued. So those that are overvalued, by the time investors realize that they are not making enough profit to justify their market prices, investors, and bear in mind that many investors are looking for benefits. So beyond capital gains, investors are largely looking for benefits. Are they paying interim dividend? Are they going to pay final dividend? And if a company is not paying both interim and final dividend, and they realize that the stock price is clearly cannot justify, the intrinsic value of the stock cannot justify the price at which it is selling, then investors may likely move away from such stocks. So you may see some correction, but the corrections is not going to be a blanket correction. The correction will be focused on those stocks that are clearly overvalued.
So we saw UBA, because they didn't pay dividend. We saw a lot of profit taking on them. And then we also saw an Access Holding. And then there's the news to Access from the CBN, you know, that some of those, their international assets. We saw they did a lot of acquisition last year, but it seems they are now being instructed to lose some of that. And it does, and since then, we've seen the price. The price has dropped from 30 to 25 naira. I believe yesterday it closed about 23 naira, talking about Access. Would we say that perhaps some of this news streaming in now overtakes the sentiment of investors taking position for earnings?
No, what I would say is that, like I pointed out earlier, that decisions of the investors, particularly the discerning investor, the PFAs, institutional investors, are based on facts, their projections of future earnings of the company. In the case of Access Bank or Access Corp, bear in mind that they did not pay dividend. People were expecting they would pay dividend. And if you look at their performance for 2025, you actually see a very strong performance. Gross earnings grew to 5.5 trillion from about 4.8 or 4.7 trillion. We saw profit after tax at 743 billion, up from about 642 billion. So those are quite strong performance. Of course, earnings per share declined because of the increase in number of listed shares. I don't think that's why investors are. So investors are not exiting or selling their stock because of performance in terms of financial performance. They obviously protested that dividend was not paid. Then on the issue of rationalizing some of their offshore subsidiaries, it's beyond the central bank directing that. It's just a rational thing that businesses do. If you have multiple operations outside the country and you need to capitalize it, because each banking institution requires a minimum capital base. Everywhere in the world, there is always a regulatory capital and operating capital you need to operate. And the investment you made, the investment you made in that particular jurisdiction is not giving you enough return as to justify to continue to hold that investment, the appropriate thing to do is that you assess it and say, look, I can't continue to keep this investment. I don't know how the CBN arrived at the decision to ask them to rationalize, but I also believe that the management of Access Bank, the board of Access Bank, would have viewed as appraised their investment in other parts of the country, other parts of the world, and determine those that are not profitable. And they will be willing to sell them down or offload them to other investors and invest that resource elsewhere, maybe in the local market or elsewhere where they are making good returns.
So, I mean, you said that perhaps investors are protesting. They're not paying the dividends. Do you know how long this protest may take? Because the price is really dropping.
Well, I think it will soon bottom out, because if you look at the current price, about 23 naira, and you consider their offer price was about almost about 20 naira or thereabout, the last offer they made. So you're going to get to what we call support level. That support level is a level where investors are saying, look, I bought this at 20 naira or thereabout, and it's 21 naira. Even if I sell at 22 naira, the cost of exiting that stock will even make me to take a loss. So I will hold. And given that the underlying fundamentals of the bank is strong, like I said, profits grew by about 13% from about 642 billion. Profit after tax to about 743 billion. That is very important. And if you look at the top line, which is the revenue, it's also grew by about 16% to about 5.5 trillion. So, and they also grew their balance sheet with about 51 trillion. I think those are what investors will be looking at. So bear in mind that investors will protest. It is always emotions attached to investment. And if you expected a dividend from one of the fugas banks and they didn't get it, just like they didn't get from UBA, and you could also see that even the negative sentiment of UBA is moderating when they began to moderate when they saw the first quarter return performance of the bank. So I think we're getting the support level where investors are not going to sell the Access Bank holding, because selling it will mean locking in losses. Because if you take out your transaction cost and you compare, even if you bought the public offer, that is the last public offer, you're going to take a loss. So at that point, investors will hold, unless they have other factors, other reasons to want to exit. But if it's based on their financial performance, or that the central bank directed to sell down some of their maybe not very viable offshore location investments, I don't think that would compel investors to want to lock in losses on a company or a bank that is profitable.
All right, so of course we did see that happen with UBA, and then over time we saw that the investors came back again and sentiments turned around. So I'm sure that will be the story of Access Bank. But let's look at the market wholly now. At first, we were told that it is the pension funds that's driving the liquidity increase, liquidity so in the market. And we're still being assured, I believe. I attended the NGX AGM, and the executives there say that it is domestic fund that's still driving these positive sentiments we have generally in the market. But the pension fund, is it still the impact that's pushing the market, or are there other funds that have come in? Because, I mean, the market is actually very positive.
I think a large portion of what we still have in the market is still local investors. Of course, Nigeria got some relief by when Russell removed Nigeria from, brought Nigeria into the frontier market portfolio. So that should only bring foreign portfolio investors. But we're yet to see that. Bear in mind, we're moving towards an election period. And we're also, the world is witnessing a very volatile macroeconomic environment. So investors are not ready to take risk in emerging markets, particularly variable income assets. So I don't think foreign portfolio investors are going to come in immediately. So, but you have a reasonable volume of liquidity in the country today. If you look at how investors play the market, you observe that when yield and fixed income instruments come down, decline, investors shift on their portfolios in fixed income instruments and overweight them in equities, which is what is happening. We've seen Treasury bills yield dropped about 16.15%. In the last few auctions. I think this week's auction came at about 15.19 or 15.15%. So investors are looking at equity market has given me, as at the close of business, equity market has given them about 54%. So you compare that to about 16%. Then you say, look, I'd rather play the equities market than to play in the fixed income space, because the yield or the return on equities is far above the return you can get in the most viable alternative investment class, which is fixed income. So investors start staying in the equities market. And bear in mind that beyond the PFAs, you also have institutional investors. You also have a huge percentage of retail investors who are coming back to the market because there's no more liquidity in the economy. Last week's Treasury bills auction, about over 2.2 trillion was bidded for just about 600 or 500 billion that was on offer. And the rest of that money that didn't get win their bid, they will look for alternative investment instruments, and the equity market presents that. Like I said, the most important, the equity market has given a yield, return year-to-date return about 54%. The fixed income yield is about 16%. So it makes sense for you as retail investors to play in the market. But I always advise that you shouldn't, nobody should follow the sheep syndrome or the head syndrome, because people are buying. So people are looking for what is the next penny stock. Let me buy. You have to make sure that you buy fundamentally strong instruments, because like we said earlier, we may see corrections. The correction is not going to be across board. The corrections will be largely on those stocks that do not have strong fundamentals.
So, I mean, I've also seen, I think it's a new trend. I don't know how coordinated it is. And I'm sure you've seen in some of the social media platforms, there's adverts about the NGX and all that. Do you think that's also maybe contributing, widening the knowledge gap or widening the knowledge base for Nigerians when it comes to the stock market?
Yes, a couple of factors are broadening or widening the knowledge of investors. One, the positive public relations that NGS and public communication NGS is doing. Comments, statements from Nigerian Securities Exchange Commission assuring investors of the integrity of the entire capital market. Then, for the operators like us, Cowley Asset, we now have multiple channels that people can trade, access the market. You have your web-based application where you can use your laptop, your iPad, your phone to log in and trade directly. You have your mobile applications. So all these things are incentivized or creating awareness about the system. And bear in mind that if you look at the demography of Nigeria, a lot of young people are more educated. A lot of more young people are looking for investment options. They are investing in cryptocurrency, all sorts of asset classes. And because you now have convenience in terms of tools which to use to invest, so people are getting more awareness. Financial inclusion is expanding at a very lot more knowledgeable about where to put their money. People no longer put their money under the pillow like we used to say. People know that the time value of money, every money you have should work for you. People are talking of alternative multiple income streams, and they're looking at where else we are investing: equities market, fixed income market, real estate market. So that level of awareness is a lot more heightened, and that's why the capital market, equity market, is one of the beneficiaries of the improvement in knowledge base and financial inclusion.
And now we have the T+1 starting on the 1st of June. I guess that should also drive some positive sentiments to the market.
Yes, but beyond positive sentiment, one of the greatest benefits of shortening the settlement cycle is increases transaction volume, increases transaction turnover. So I can buy today, settle tomorrow, or settle on Monday. Today Friday, I buy on today Friday, settle on Monday, and as I'm settling, I can use the same process to play the market on Monday. Unlike you have to wait for T+2, where it will settle on Tuesday. So it's only when I expect my inflow to come in I can trade. So you can almost trade based on the fact that your trade, the previous day's trade, is settling that day, and you can apply the process to a trade knowing before you settle the following day, before it's due for settlement, you would have received your proceeds. So that increases transactions volume and the velocity of investment in the market.
But I wonder if the extended trading hours has had any impact yet, or we're still watching.
Well, you know, it's very recent. I mean, the station started, I think, on 27th of April. So today is just 8th of May. But you're going to see that in the daily volumes. By the time we see the close of volume traded this week, we may see an improvement in trading volume. And bear in mind that the extension in time, the trading time, is targeted at people in other jurisdictions outside Nigeria, in other time zones. So awareness has to be created. The other supporting macroeconomic conditions also have to be more appropriate. Like I mentioned earlier, you are dealing with a very volatile global macroeconomic environment where investors are pulling back from what they may call higher risk emerging markets to stay in safe zones. So all those things have to reverse. And then investors in countries would have different time zones when Nigeria would be aware that the markets are open to them to trade. And it will take some time for us to get that level of pronounced change or improvement in volume driven by the change in trading hours.
All right, Mr. Johnson Chukwu, thank you so much for your time and chatting with us. Mr. Johnson Chukwu is the Chief Executive Officer at Cowrie Assets Management Limited. Thank you and enjoy the rest of your day.
Thank you for having me.
So other stories now. Africa's richest man, Dangote, is moving to list a portion of his cement business on the London Stock Exchange as part of a broader strategy to raise capital and expand operations. The proposed listing is expected to involve a minority stake in Dangote Cement, one of Africa's largest cement producers, with operations across multiple countries on the continent. Well, according to reports, the move is aimed at attracting international investors and strengthening funding for the company's ongoing expansion program, which includes increasing production capacity and developing new plants across Africa. The London listing also signals renewed interest in global capital markets after early attempts were delayed because of regulatory challenges and shifting market conditions. And Nigeria Revenue Service is extending weekend tax services nationwide from today, May 8, to June 27, 2026. And it's part of efforts to improve taxpayer support and ease compliance processes. The agency says that tax offices across the country now operate on Saturdays to assist individuals and businesses with registrations, filings, and other tax-related services. The extension is also aimed at preparing taxpayers ahead of a rollout of the Rev 360 platform, which is expected to enhance digital tax administration and streamline revenue collection processes. At the 2026 United Nations On Science, Technology and Innovation Forum, founder and Chief Executive Officer of Waterlight Save Initiative, Prince Ero Ibafidon, representing Nigeria, addressed global leaders and stakeholders at the 11th Annual Multi-Stakeholder Forum on Science, Technology and Innovation for the Sustainable Development Goals at the United Nations headquarters in New York. During the thematic session, one of the forum, Dr. Manfredon focused on transforming water systems and accelerating progress towards Sustainable Development Goal 6 on clean water and sanitation through science, technology and innovation. He described the engagement as a significant milestone for the country, noting that it reflects growing global recognition for the organization's advocacy on sustainable water solutions.
We have seen that decentralized solar-powered water system and smart distribution models can rapidly expand access while strengthening resilience. These are not pilots. They are proven scalable solutions. We have three priorities. First, climate-resilient decentralized infrastructures that reaches communities beyond traditional grid. We urge the government, development bank, and private capital to establish blended financing mechanism and catalytic investment platform that move beyond pilot and accelerate deployment at national and regional level. Through our HIL framework, we connect water system to health, education, food security, and economic mobility because water underpins multiple sustainable development goals. Excellencies, the window to 2030 is closing. Let us be the generation that did not manage the water crisis.
Let's take a break now. When we come back, we'll be discussing about capital, private capital in Africa. We found a report on how the capital fared in 2025. We'll talk about that after the break. Please stay with us. welcome back to watching Business Morning right here on Channels Television. Let's talk about private capital in Africa. Reports found that in 2025, African investors accounted for 21% of commitments, although this remains relatively modest. On the exit side, domestic investors drove 68% of acquisition. That imbalance suggests that domestic capital is not just participating, it is increasingly providing liquidity, setting valuations and enabling capital to recycle locally. And this shift goes beyond the usual less foreign capital narrative. What's changing? Who's changing it? What's the new trend? That's what we'll be discussing this morning. And we're doing that with Rachel. Rachel Oshodi is the Chief Executive Officer of ARM Harif Infrastructure Fund, joins us virtually. Rachel, good morning. Welcome to the program.
Good morning, and thanks for having me.
Okay, so ABCA reports, tell us some of the highlights of it and perhaps what trend you have noticed from this report.
Yes, I think this report tells us something very important. What we see is African private capital market beginning to mature, and to mature in a grounded way. So for a long time, when we spoke about exit, for instance, you mentioned the 68%. The assumption was essentially that liquidity had to come from outside the continent, from a global strategic buyer or an international financial sponsors, and occasionally through a listing. So what this report suggests is that the story is changing, and 81% exit across Africa, up 27% year on year, the highest second level on record, right? And local buyers accounted for the 68% of private capital acquisition. So it's a very meaningful signal. It means that local capital is no longer passive. We have a pool of savings, as we know, sitting on the sidelines, and it is increasingly becoming part of the liquidity architecture of African market. So for me, it tells three things essentially. So first, African buyers who are based locally understand African asset better, and they're signaling to the rest of the globe that it is okay, and that risk premium and that risk perception that we often see from outside, it helps mitigate that. So they understand the political economy, they understand local demand pattern, so they can make more natural to global investors, for coming into this asset in spite, I would say, of the global risk cycles. So second, it tells us also that domestic capital is starting to move beyond just government securities and listed equities into more productive capital formation, which is very important, particularly when it comes to infrastructure, energy, logistics, and digital infrastructure, and other sectors that we really care about that are very important for economic growth. But as you said, we should be careful and not overstate the point, because it is progress, but there's still a long way to go. You started your introduction by saying that only 21% of local investors contributed to the fundraising and to participating in real economy. We still have a long way to go, but it's the good beginning, and I hope and I think we will continue to see progress.
So, I mean, the report also notes the higher participation of domestic capital. That, I mean, should be good news. But where are they coming from? What countries, what sectors? Do we see a sustainable trend in the source of this domestic capital?
So we see, and we see that at home. Starting here in Nigeria, there has been tremendous progress over the last few years. For instance, at ARM Harif, we started 10 years ago with one DFI anchoring the fund and a series of pension funds that have accompanied us into this journey. I think, it's a demonstration effect. We, of course, need regulation that would help that, and we've seen migration in the positive side with regulation now incentivizing and pushing some of the pension funds to move outside and to go into alternative assets. We see the same happening in South Africa. South Africa has been a bit ahead when you look at the amount of capital that they have is quite substantial. But there's still a need as well to push those institutions to go into more alternative assets. Kenya is a very good example as well. Morocco, if I go a bit north, is a very good example as well. And we see Botswana as well coming out with a lot of push from domestic capital, as well as activities also and regulation at the capital market coming into that. So there has been report, and we know the push that is happening. But what has been holding capital back essentially has been first the regulation, as I mentioned, and pension funds and insurance company are rightly regulated to protect beneficiaries. And so those regulations are also moving to better understand the vehicles and platforms that are being created to enable those institutions to come in while still abiding properly to the regulation and also to their fiduciary duties to their, the pension owners of capital, which are our moms and pops and ourselves. So the second issue is product design. I think for a long time, we've had platforms essentially that did not cater to the realities of those domestic investors. And now we're seeing more and more innovation, and we are a good example of what we've been able to do to really create a platform that enables the local capital to come in and to essentially not bear more risk than it is supposed to do. And for that, blended vehicles, as we've heard in the previous segment, are really critical, where DFI capital in particular is coming to catalyze and credit enhance those domestic investors, enabling them to participate where they would not have otherwise done so. And the third issue, which is normally trust, and domestic institution needs consistent reporting, very strong governance and valuation discipline, predictable cash flows visibility, and credible managers with track record. And we see more and more now, and we also more vocal now in terms of what we've been able to do in the market, telling the story, the good story of investments that we've been able to do, providing good returns, sound governance, and you will see more and more fund managers not shying away from telling that story, which is very important and critical to really changing the landscape by finally telling the good stories and not just the bad ones that make the headlines.
Yeah, and in spite of all of this, the report still notes that we're still at a stage where we can call modest. We still have a lot of potential that have not been explored. So what reforms or financial tools do you think can quickly unlock some of this other capital?
Yes, absolutely. I would focus on 4 areas. So the first one is really the risk-based regulation. So regulator continue to protect pension contributors. Both the rules need to evolve from simply saying this asset class is too risky to really asking under what structure, governance and risk control can this asset become investable. This distinction is very critical. When I look at infrastructure, for instance, globally, the infrastructure asset class in Africa is the lowest risk asset class globally. Beats Europe, Latin America. Yet we see still a resistance from domestic investors to come into infrastructures. One, because it's unfamiliar, the risk allocation is not well understood, and also there's a liquid phase, right? When you develop the project to when the project is actually built and start generating cash flows. And that phase of illiquidity is really also what the domestic investors do not like. So, but what has been done and what can be done is to structure a portfolio where you have a diversified infrastructure, diversified infrastructure assets. Some could already be operating. Some would then, of course, be needs to be built. But you can then structure your portfolio in a manner that caters and responds to those constraints or pain points that have been identified in the market. The second tool is local currency investment vehicles. And this is especially important for infrastructure. We've seen, not just infrastructure actually, for the economy, because we've seen so many good projects or good companies earning revenues in local currency, but historically have a lot of the capital being raised in dollars. And that creates an FX mismatch. And if the assets earned in local currency, should it be in Naira, in CD, or in shilling, but the capital expects dollar returns, someone is carrying that currency risk. And too often, that risk makes otherwise viable project unviable. And we've seen that a lot with the devaluation that happened in Nigeria, for instance, in 2024. So we need more blended local currency and hard currency structures. And what we're doing at ARM Harris, for instance, is that we've launched a multi-currency blended finance structure that is essentially solving for all these issues that I've mentioned, where local pension capital can participate in a way that better matches the underlying asset revenues. Capital is also participating in the dollar vehicle and playing a catalytic role, enhancing and supporting the commercial capital locally. So the third area really is the exit market. And I know there's been a lot of discussions around exit, and we need more pathways for investors to exit infrastructure and private market assets. And that includes secondary transactions, infrastructure securitization, listed infrastructure funds, REITs like structure where appropriate, and stronger capital market listing framework. There's a lot of work being done as we speak on those things. The discussions, even with the international community, has moved to the secondary transaction. And so we're really pushing to be able to have exit, to be able to recycle that capital so that it doesn't stay locked into just the first phase. And we need to have credible listing and securitization pathway for asset to be able to move off the balance sheet into broader institutional portfolio over time. So to summarize, I would just say it's that we need domestic capital to be able to unlock investable product, a product that are locally relevant and properly governed, and risk-adjusted, transparent, capable asset that would deliver real returns.
All right, thank you so much for that. Rachel Oshodi, Chief Executive Officer of ARM Harris Infrastructure Fund. And of course, we certainly do hope that more capital, domestic capital, would be unlocked and channeled through those relevant products and services that you talked about. Thank you so much for being a part of the program.
Thank you for having me.
Let's take a break now. When we come back, we'll go global. Please stay with us. It's now time for global news, and we're starting from what the World Food Organization is saying. They say that food prices have gone up for a third consecutive month in April. This is according to the Food and Agriculture Organization. They're saying that it's driven mainly by higher costs in key global food commodities. According to FAO data, the food price index increased in April, extending gains seen in previous months, as international prices of items such as vegetable oil, cereals, meat, and dairy continue to climb. The UN agency notes that supply pressures, energy market volatility, and geopolitical tensions contribute to the upward trend, with vegetable oil prices recording one of the strongest increases during the period. Despite the monthly rise, the FAO says that global food prices remain below the peak levels recorded in 2022 following the outbreak of the Russia-Ukraine conflict. And the Bank of America has highlighted fiscal concerns in Germany and the United Kingdom as energy price corrections have shifted market attention to other economic issues. Germany is returning to regular budget planning for the first time since 2023, but the 2027 budget faces challenges. Defense spending is being increased, while economic cycles are also affecting the budget. The peak of the monetary easing occurred in 2026, and discussions have now shifted towards tightening. In the UK, risks of a leadership challenge could increase following the May local elections. If a leadership challenge occurs and results in a left-leaning Labour leader, risks of higher borrowing would rise. A negative market reaction in such a scenario will make breaking fiscal rules less certain. And European Central Bank President Christine Lagarde said that even euro-denominated stable coins would create risks for financial stability and monetary policy transmission, questioning the case for introducing such instruments. While they could lower financing costs in the euro area and boost common currencies' global pool, there are significant trade-offs, according to Ms. Lagarde. She shared this today. And then to some corporates now, Nintendo company says it will raise prices for its Switch 2 gaming console and related services across major markets, citing changing market conditions and rising costs. The Japanese gaming company said that the price of Nintendo Switch 2 in Japan will go up by 20% to about 59,980 yen from currently 49,980 yen. That's from May 25. Prices for existing Switch models in Japan will also increase by as much as 33%. Shares of the company jumped nearly 4% to 7,660 yen earlier today. Outside Japan, Nintendo said that the Switch 2 price in the United States will rise to $499.99 from $499 beginning from the first day in September, while the European price will increase to $499.99 at euros from also the same date. More corporate now, Toyota Motor Corporation is clocked to weaker annual operating income for fiscal 2026 as high U.S. trade tariffs is eating into automakers' margins despite stronger overall sales. Toyota also forecast a softer than expected operating profit for fiscal 2027, citing an impact on vehicle sales and earnings from the Middle East conflict. Shares of the automaker fell 1% in Tokyo trade compared to a 0.4% drop in the Nikkei 225 index. Toyota's operating income for the year to March 31 fell to 3.78 trillion yen. That's about $2.4 billion from 4.79 trillion yen a year earlier. And we know that it's the world's largest automaker at this time. And still from Asia, Japan Sony, the forecast annual operating profit is below market expectation, while it has unveiled a new share buyback and reported stronger fiscal 2025 earnings. The entertainment and electronics conglomerate expects operating income for the year ending March 2027 to reach 1.6 trillion yen. That's about $10.6 billion, missing analyst average estimate of 1.63 trillion yen, according to Bloomberg. Well, Sony forecast a 30% rise in operating profit at its game and network services segment this year, benefiting from the absence of impairment losses related to Bunge assets booked in fiscal 2025. However, sales are expected to decrease by 6%. The company approved a share buyback program of up to 500 billion yen, that's about 230 million shares, to run through May 2027. And Taiwan Semiconductor Manufacturing Company, TSMC, has reported a 17.5% rise in April revenue, supported by sustained demand for advanced artificial intelligence chips. The world's largest contract chip maker said April revenue rose to $410.73 billion, that's about $13.08 billion, from $349.57 billion a year earlier. However, It fell 1.1% from March. For the first 4 months of 2026, revenue climbed 29.9% year-on-year to 1.54 trillion, according to the company. And still staying in the markets, let's see the close for Thursday from the United States with our correspondent, Maria Bird.
The U.S. stock market retreated from record highs on Thursday as the Dow Jones sank at 0.6%. The S&P 500 was also down at 0.4%, and the heavy tech Nasdaq was down at 0.1%. As many investors were watching to see what would happen between the U.S., Israel, and Iran, as the one-page proposal could mean the U.S. economy could see a rebound in coming days. If this proposal is accepted by all parties, we could see it into the war, which could mean a stabilization in the global economy.
And so just before we say goodbye on the program, let's see what's happening in Nigeria's local bourse. And we see there's a recovery from yesterday's loss. Yesterday we lost about 1 trillion naira. Not a very good place, but I mean, it's a normal market cycle. If you're an investor and you put in some money, then you need to take profit. That's what happened yesterday. But we see recovery this morning, even in early trade. It's up 0.83%. That's a lot. That means I have like 1% gain by intraday, hopefully. At least I'm wearing green today. I'm not wearing red. So the market is up this morning, 241,715.38, and the all share is 0.83% in the red. Access Holdings is still in the red. However, as Mr. Johnson Juku said, investors are still protesting the non-payment of dividends by Access. So it's down this morning, 0.21%. The price is still around 23 naira. It's 23 naira 45 kobo. At this time, UBA has gone through that, and it's on a winning streak now. It's up this morning, 0.13%. First Holdco, we just told about their results earlier. That seems pleasing to investors. They're almost 10% up this morning. That's First Holdco. Lincolnshire is also up, as well as Champs. Champs also experienced a lot of profit taking, but we see it's recovering now. Beggar Paint is also positive, almost 10%, 9.97%. Mayor Paint also positive. But on the flip side, we have Stanbic IBTC, we have Geregu. Geregu is still down. Total Nigeria also is still down. But anyways, the good thing is that the market has recovered, and maybe we'll see more than 1% up at intraday. When I'll be back for Business Incorporated, I'll be at 1:30. I'm in John McQuarrie. See you then.